What's up, premium members? Welcome to the next core content video. This is going to cover how I enter off of Mark IIs and high-low tapbacks. Um, yeah, I mean that's pretty much it. That's what we're going to be covering. Again, as I always disclaim before, um, this is not a mechanical strategy, so none of the stuff that I trade is mechanical. All of it requires discretion. The execution models themselves are mechanical, but it is not mechanical when you choose to use them. So this is me saying, please do not just go look for this to occur mechanically everywhere and trade it every single time that you see it, because you need to have other confluences and bias alignment and things like that. Otherwise, you're going to get run over. Um, so let's go ahead and identify a couple examples and we'll dive into it. I'm sure that we're going to find a lot of low tapback examples. And then we'll also cover the Mark II after high-low tapbacks. And we'll go over again, we'll reiterate the difference. Obviously, you guys know already if you've watched other videos, but second disclaimer, if you have not watched the other videos, please get the hell out of here. Go watch other videos on market structure, candlestick structure, the Mark II, the high-low tapbacks. You're not even gonna know what they are. Non-structural lows, non-structural highs, all that stuff. Until you're not gonna know what I'm talking about until you watch those. So go watch them, come back, and then let's chit chat about it. And I will locate a couple examples, and we'll get to learning. Sorry, I forgot to mention, obviously it'll be in the title, but yes, we are also going to be talking about entry models using non-structural lows and non-structural highs. So I actually pulled up that example first, and I'm going to go ahead and mark out what the low tapback is in this scenario, and then I'm going to go ahead and mark out the non-structural low, which I already actually have marked right here. We'll talk about how you can utilize these for entries. So right here, we have a valid swing up. And this is a swing up because this is the highest bullish bodied candle, right? But then we go higher right here with this little guy. So from there, we would reassess and look for a closure underneath this, find a closure underneath that. And now we have a swing once we go close above that valid external high. After that valid external high, regardless of whether this is a structural or non-structural low, the lowest point that price travels into back into the zone before leaving and going above the high that it came from, right? Above the high that it came from, which is this guy. And then this is the lowest point that it tapped into. And then this low point sent price to go above that high, right? Sent price to go above this high. So this is our low tapback. Structural or non-structural, this was our low tapback. It's the same concept as a Mark II, except on a Mark II, you would identify it from a flip. So for instance, like in current price action, here's a 15-minute flip up right there. There's the low tap back. You see the low tap back, but because it's in a flip zone, it's from a flip zone instead of a swing zone. We call it a Mark II, and that's because the Mark IIs are going to be generally more powerful confluences for different, for further targets. Sometimes that's not the case, like this example on the screen here. But let's go back over to this low tap back scenario real quick. So I'm gonna circle this and then go to it on the 1 minute. And I'm gonna have to paint a picture for you guys on what actually happened on the 5 second. I don't think that I can um, show it perfectly, but if I can't, or if I think it's necessary, I might actually pull it up on FX replay as well. We might do that. Let's just see real quick. Let's go to the 1 minute. See if it'll let us go all the way back to where we just were. This is not letting us go. Yeah, no, it's too far back. I have the premium membership. I don't understand how this works. Let me pull this up on FX Replay real quick. One sec. Okay, I made a session, pulled it up in FX Replay. So this is the 15 minute, right? This is what we were just looking at on TradingView. This is our non-structural low. First and foremost, we're going to talk about, again, reiterating what is the non-structural low. So in an uptrend, right, we have structural or protected lows. Those are the lowest points that price travels to before sending up and closing above the external valid high. We identify the valid high using candlestick structure. We identify the protected low by looking for the lowest point between the creation of the external high and the closure above the external high. You guys already know that, right? So, what is a non structural low? Well, it's when the market tries to make a low and could potentially even have made a nice fat pullback on the 1 minute, right? And it would be a structural low potentially on the 1 minute. But on the 15, this is not structural, meaning it's not protected, it's not external or anything like that. It's not part of structure. It is a low. We can clearly identify. This is where you're going to have to use your heads. And I know that that's a lot to ask for. I know that people really hate to hear that, but you're going to have to use your heads. And I know in the future people will be Magma. Well, what if what if it, yeah, how exactly, do you identify a non-structural low? I just told you. It looks like a low, but it's not part of structure. This is a non-structural low right here. So when price is trying to continue its trend up, but it can't, a lot of times something that it'll do is it'll go sweep out these non-structural lows. Why does it do that? Because people who don't know market structure, the poor lost souls out in the trading world who don't know perfect market structure, are looking at this and thinking that it's a good place to put a stop loss for longs. Stop loss for longs is where they will sell out of their contracts, right? So they're holding their contracts and they will either sell it here or they'll sell it up here, right? They're going to sell it for a loss or they're going to sell it for a profit. And where do people who control the market want to buy their shares? If they're buying, they want to buy them lower, right? They want to buy their contracts lower. So they're going to buy their contracts down here. Who's going to sell it to them? All those people, those lost souls who don't know that this is not a structural low, right? So price easily comes and wicks this out, okay? And then from there, it makes its flip up. It rips through the top, does a little wick, pulls back, continues higher. And this is something we see all the time. There's actually going to be two examples. I'm sure that there's I think there's one right before this or right after this. Um, Shoot, let me play this out real quick. There's one before or after. I gotta find it. I remember the things being like 141, and then there was like a 441 thing. I think it was this. Right. Yeah, it was this. 448. Um, So again, something that looks like a low, right? We even have a pullback. See how we, put out kind of like a high, low, high, low, high. Like this is what all these people think. A high, low. It's not a high. It's not a low. It's not part of structure. This is structure. This is a structural swing, right? This is not a structural swing because we did not pull back and close under the highest body bullish candle, and we did not go and we didn't make that pullback and we didn't go close above that pullback. So this is not a swing. So this low, once we, put the low in and climb up and then start to reject, where are we thinking that price needs to go? Well, if market structure is still bullish, then it's likely to run out the non-structural lows, right? And then continue higher if we think that it's going to go higher, if our bias is continuing bullish. So let's get into the details of the trade model right here. First, I'm going to go to the 1 minute. Over here. Okay. So, yep, this is definitely a 1 minute swing. As you can see, it is not a 1 minute flip down and then up. In this instance, Is it right here actually? I'd have to look at the 5 second. Let me identify this real quick. So we have to get into the details here because I want to go through exactly my thought process on all of this stuff. So I'm gonna look at this real quick right here and see if this was a um, flip down and then flip up on the 5 second. If it was a flip down and a flip up on the 5 second, then that would make this a swing. If this is a swing, then this is actually a flip down and then a flip back up. So the 15-minute, it would be invisible market structure, but then we would be relying on visible market structure for the narrative right there. Let's just go to the 5 second. This is the cool thing about FX replay now. If you guys don't have this, you should leave the mentorship because like I'm tilted at people who don't use FX replay. It is like the most powerful tool. You need to be using it. There's no excuses for not using it, especially if you're have enough money to be paying to be in the mentorship. You need to be putting some of your money towards that as well. Okay, so yeah, according to invisible market structure, the this is a 1 minute fake flip zone, so we would equate that to a 15-minute swing. But because we also have to couple, you can't use invisible market structure in a trending environment where it is possible to have a 15-minute valid swing that is visible, right? If it's possible to have a visible one, then you're going to be looking for that. So even though we have this, flip down, flip up, we have a swing here on the 1 minute, and then we flip below it, and then we go up, right? Even though we do that, I'm not considering this a 15-minute valid swing because again, look back at the 15-minute and we would have needed a closure below this candle, and it just doesn't happen. Doesn't happen, so we're not considering this. So we're considering this as a non-structural low. So go back to the 5 second now, and let's look at exactly what happens whenever. Well, actually, start with the 1 minute. So here's what happens when we go through that, right? We did make a flip up on the 1 minute. So we have a low and a high and a low and a flip up. Almost. We didn't actually flip up. It just wicked out, right? So it wicked out. And then when it wicked, I think it flipped back down the 5 second. That made everyone think, okay, we're gonna dump, right? Because we have a valid swing. We wick the top, but we can't close it. We flip down the 5 second. A lot of people are going to be trying to use that for shorting, right? Then we go and we actually do close out of here one more time on the 1 minute right there, and then it rips straight through. So we have this is extremely powerful. This what's going on here. We have let's just make sure. So over here, right? Structure is saying high, lower, low, and then we have there's swings going on, right? There's a swing right here, and we swing above it, we swing up, we swing down, all around town, okay? And then we get down to here, and we have a swing down right there. And then we have um, another swing down right here. And then we flip up above this. So right off rip, if I'm taking out, if I have other confluences, right? If I have other confluences and I have a 15-minute sweep of a low tap back or a high tap back, then a 1 minute flip is for me a good opportunity mechanically for my final confluence for an entry. So if I was just using the 1 minute, the way that I would do this is I would look for something like I would look for this closure up above this line right here. And then once we get that closure, I would maybe look for the space in here, right? This fractal between this high and this low that continues as higher. Maybe I would look for, price to retrace just a tiny bit. Maybe I would market enter, maybe a tiny retrace, whatever it is, right? But I'm putting my stop underneath the flip, believing in the trade. And I'm targeting the high that it came from because that high is an external high, and external highs are a lot of times in bullish market trends good draws, right? Because if the market is going to continue to go up, then it needs to go and take out that external high. So it has an objective. Currently, if the market is structured bullish, then the market has a definitive objective at this very moment to be going and taking external highs and creating protected lows, right? So we're looking for price to go create that. Now we can zoom into the 5 second here and find out how I actually entered off of this because it's a little bit finer in the details. And it does use a little bit more discretion than people are going to be comfortable with, but that's okay. So right here, we have a flip um, down on the one, or we have a swing down on the 1 minute, right? So the 5 second, it swings down, it flips up, it flips down, then it flips back up, right? So we know that as a 1 minute flip up because it's a 5 second double fake flip zone. In this instance, we're dealing with a swing, right? And I went ahead and marked out my 60%. So I used the fake flip zone in this instance, okay? Right here, once we came and closed down below, let me just scoot this over so you know exactly where we start to look, right? Once we close down below this line right here, which we closed on this with 1 minute, okay, then I'm marking out the 60% of this swing. And what I noticed was we came up above the 60%. We went and tried to head out of the zone, and we made a very strong change in state of delivery on the 5 second, showing this double pullback model, double order block, whatever you would like to call it. Okay, and we pulled back really heavy up all above this. And when we closed there, I simply just put that there and said, I believe that we're going to take this high out right here. And I believe that when we take that high out, it's going to be a catalyst for us to just continue through the top. We had already swept that 60% out. Not that we had flipped down, we didn't sweep it out and then flip back down, but we were more showing signs that we were not going to make another swing down. And you know, we had already made the draw, right? The draw on liquidity, which is very important for me. And I'm hammering all this home because, again, I want you guys to understand that there's discretion. There's a lot of things that go into the decision making of each trade because you have money on the line. That's how it always should be. So that's where I got in, was a little bit lower than where everybody else would have gotten in. And then, as I always say, for entry models, we're going to also talk about TPs. So go back to the 1 minute, and that's how I was able to identify where I wanted to take profit at. I looked for the fake flip zone on the 1 minute for starters. I looked how we flipped up here, and then I looked at how we flipped back down. And once we flipped back down, I targeted the space that we retraced up to. So we have our high, our low, our high, and then we go and close below our low right here. So in that instance, your first target could easily be right there. And if you wanted to be even more conservative, right, and secure it at like a 1.5 R for like your first contract and then leave runners, you could even just target something like the bottom of this little um, swing right here. Okay. So there's all kinds of options. You could target there. You could target the 50% of it. We did get a little reaction off of it that probably made some people poop their pants if you were in long and holding it. Um, but there are places to take profits everywhere. The best practice of taking profits is just to actually make sure that you fucking take profits. But again, ultimately, we're going to be looking if we believe that the trend is going to continue, that's going to influence your take profit. So, you know, in this instance, if I believe that the trend is going to continue bullish, which I did, my ultimate take profit would be the top. Or even better yet, you could go as far as to hold. You could hold it until price makes its closure out of there on that respective time frame. So if we're looking for a 15-minute swing up, then we would need a closure above that line so we could potentially hold until we get that closure, right? Or you can just trail your stop loss behind each swing. A lot, like I said in other videos, one of my practices that I use is I like to try and carry my stop loss 2 swings behind if I can, if it's safe to do. Um, on the time frame down. So that would be from the 1 minute. But let's get into this second example. So you're going to see something a little bit different, but it's the same idea over here, and this is the non-structural lows again. Um, this is also this is not the low tap back because this didn't send price up above the high that it came from. So this is just a non-structural low. It's not a low tap back because for it to be a for it to be a actually, I mean technically this is the low tap back. So when we came below here, you could have, you know, tried that or something, but we're just focusing on non-structural highs and lows right now. So let's go to the 1 minute, see what happens. Oops. So on the 1 minute, we have some funk going on. Really weird price action, but essentially there is a swing right here, which makes this a flip down right there. And after that flip down, we then get another swing on the 1 minute right here. And then we get a flip up because of that. And yeah, the structure in here is like so horrible to look at. Um, I'm just gonna kind of lob all this together right here because it's just such a mess. But then we have obviously a flip back down here. So price, what is price doing? What is it telling us that it's doing? It's ranging. It is flipping up and it's flipping, there's flipping down, it's flipping up, it's flipping down, it's trying to flip up, it's failing, right? And then it's sweeping something out. So overall, all we've been informed on so far is that the 1 minute cannot make a decision. It can't get anything done efficiently. And the 15 minute has established a non-structural low right here, but the 15 minute is structurally bullish. Okay, still structurally bullish. So in this instance, if we cannot identify a if we cannot identify a flip up, right? So in this right here, we're identifying a flip down, and then we're identifying a swing down. Okay, so the flip down, the swing down, and then we do flip up. So there are two ways you go about this. One is you can use just the 1 minute and you could potentially say, hey, I'm looking for price to continue to make swings up. This margin is not large enough for me. The risk to reward ratio is not good enough. I'm not going to hop in here with the stop loss down here, targeting here, obviously. So I am more interested in looking for the 50%, right? We have a flip. Sorry, the 50% is a little bit lower. We have a flip right here. This is a flip up on the 1 minute. So you could look for that 50% tap and then go higher. That could be an entry for you. Or on the 5 second, you can look in and use invisible market structure. So the market is getting really volatile. It's making these aggressive two leg pullbacks, right? It's trying to climb up, dumps down, and once it runs through that and gives us the opportunity lower, um, this is the way that I would try to use it. I would see that we have this low point established. We can't go below it. We do the double pullback right here. We make a structural flip up on the 5 second, and then we come down and yet again make a series of higher lows. And there's an opportunity right there for you to just get that confirmation with another pullback and say, you know what, okay, I believe in this flip. I believe it's going to lead us up higher in this instance because we have now taken out a non-structural low on the 15. The 15 is still bullish, and I think that we're primed for a flip up here. The market has already shown us that if it's swinging down or if it's flipping down or up or whatever it may be, that it doesn't really mean much. So in this instance, how I would use my discretion is to say, yes, I am going against this bearish swing right here, but I mean, there was a bullish flip right here, there was a bearish swing right here, a bearish swing, like none of it is really meaning anything. We're ripping up and down. We take out our swing and then boom, we can head up. and ideally to the top of there, or you could look for the closure of this candle right here, this 15-minute candle above. But again, this is not an example where I would be looking for the closure above. To be honest, I would just be looking for more conservative targets like the top of this or even wicking this, because nonetheless, even though we do sweep out a non-structural low and go higher, we actually don't make a structural low. So we leave this as another non-structural low, which could potentially give another reaction later on. Let's just see if it does, actually. I'm curious. I wonder if we ever even come back to do that. Because it's not a structural low, so this is an example where people would see this here marked out, and it could take this, and people would think, oh shoot, it just took out a low, and that convinces everyone to, get stopped out. I think that this is actually probably going to get swept and go up. Let's take a peek real quick. Maybe I can show the example in real time. That might be more helpful for some people. Let me set this to 1 minute. Sorry, one sec. Okay, let's keep it playing out. So we do get a reaction and then go through the top. This one is interesting. So I was explaining non-structural lows and highs and how it doesn't necessarily matter about the trend, right? We're not talking about whether it was a low tap back or a high tap back. We're not really concerned. This is actually a low tap back example that we can get into. So this is yes a non-structural low, and it's also the low tap back, ironically, because we close up above. The lowest point that we need to travel to into this swing is right here before continuing higher. So we've left this non-structural low unmitigated as a draw, and we haven't established a new structural low right there. We actually do establish another one here due to some manipulation, right? So we have another swing right here, which means that we actually had a 15-minute flip down. But I did call out to you guys for us to be taking this long right here. And that's because it's that low tap back and it's a non-structural low on the 15. Okay, so a non-structural low and a low tap back, that's an even better confluence because it's much more likely to be a stop raid when it's getting taken out. So here we can clearly just identify a very obvious flip where we go up above our highs on the 1 minute, right? So we have a low and a high and a lower low. We make our flip up right here, and there's an entry model right off rip for you if you don't want to use the 5 second. We can just go ahead and hop in with our stop loss below the 1 minute if you have all the confluences aligning for it, right? And targeting up to the high you came from, or even for a closure on the 15-minute, which would be right here. Okay, so there's an example of that. But I would also say you need to be careful in this instance, because if you're going against this, then I would, like, let's say I had 5 contracts, I would be out of all 4 by this point right here. You're hitting 50% of a flip zone, and you should consider yourself very lucky if you can get through that and continue on the way up, right? And then let's go into the 5 second and talk about the details on how you could enter this even more refined. So right here, first of all, I'm on the 1 minute still. Sorry, I said 5 second, but I'm still on the 1 minute. We're gonna go ahead and mark out our swing, and we're gonna go ahead and mark out the 60% right there. I got this silly ass thing on here. I mean, it's distracting me. I don't need the 50% on here either. Okay, so we have our swing down, right? And what we're trying to do is we're trying to identify a 1 minute flip up, okay? We're trying to identify a 1 minute flip up. So you're starting to see how the fake flip zone model can apply to all of these settings, right? So let's go to the 5 second. This is gonna blow y'all's minds. Go to the 5 second. We're looking for price to mitigate the 60% right here, which it does. And then we're looking for price to make a structural flip down, which it does right here. And then we're looking for price to go and simply just travel back above this. So that will give us a lot of information. We sweep that out, we come back in for a retrace, we make some double lows right here, and you can have an opportunity to hop in. Now, in my mind, how I trade it, I still have my stop loss down below here. Okay. And that's because we still, even though we have flipped up above this, I've seen on numerous occasions that we can still go take this fake flip zone low out from the 5 second. We can still go take that out and then push through. So I don't want to get caught with my hand in my pants or whatever, just sitting here thinking, oh, this was going to work out great. I have this tight stop loss, getting rated and then missing out big time. Because a lot of times you're not going to get a confirmation. Like this is not going to be some sort of flip up or something. It's just going to start to trend up. And you're like, oh, hey, well, maybe it's just trending up and I should short it, off the retrace of this double fake flip zone. Nope. If the 1 minute has this 60%, this for me, if my bias is long already, and I have a flip down after the 60% is taken, and I flip up above that after that 60% is taken and flip down and flip back above that, this is locked in for me. I'm taking this until it goes down here or it goes higher, because I'm bought in, right? I'm bought in. So I'm not taking this trade thinking I'm just targeting here. I would not take this trade if I was thinking I was just targeting there, right? This is how you would take the trade from a mechanical perspective, because on the 1 minute, you're looking for that 60, you're looking for the sweep, you're looking for it to go and flip up, right? But we're using this in a fractal way. So we want to identify that the 1 minute is going to flip up a bit earlier than everybody else. We identify that the 1 minute is going to flip up a little bit earlier than everybody else because of this take right here, okay? When we take that and we believe that the 1 minute is going to flip up, what does that tell us? We've taken out a big non-structural low. Okay, we didn't hit the 50% of this zone, so don't be always waiting for that. We didn't we took out a 15-minute non-structural low and low tap back from a swing, okay, from a valid 15-minute structural swing. And now we see that we are having a very aggressive flip up. When I say the flip up is aggressive, I don't mean that this flip up is aggressive. I mean that the swing down here is aggressive. So getting through it is very powerful and very influential on the market and how it's going to be moving, right? And then look, we're targeting up through it. So it makes a slight difference. It's not the biggest difference in the world. Targeting here, right, actually is even better. I would say to just get that and be done with it, right? Why not? You can go higher, but just get that and be done with it. Maybe leave that one runner for it. I don't know. You better be, after that runner, you better be moving to break even or tighter or something, or maybe even in profit stop loss. So that's a low tap back example. And let's go to the Mark II now. And I think that you guys are, I'm not being as meticulous with this video. Not that I don't care. I do care, obviously, a lot. But I think that there's a lot of this stuff you guys already know. If you've watched the other videos, you know the fake flip zone entry model. I'm just showing you how I use the fake flip zone entry model or the structural flip entry model, basic structural flip entry model in these environments, in low tapbacks, high tapbacks, non-structural lows, non-structural highs, and Mark IIs. So let's go to the Mark II example real quick and then we'll be done. All right, I found a good local example. This is from um, last week. I like this one because I think it's going to help teach you guys something about the power of the Mark II and its precision, because it's all about precision. So we're going to use this example right here. This doesn't look like it's a swing, but if you look really, really close, you can see that we actually do travel higher with closure, right, above this candle. Okay, so because of that, that makes this right here a swing. Now you might be thinking, oh, he's just reaching and cherry picking for an example. I circled it, and you guys know what it means when I circle it. It means I went and looked at it on the 1 minute. I'm going to go show you on the 1 minute now that this is a fake flip zone. So it is a valid, visible market structure swing, and it is a valid, invisible market structure swing. Okay, take a look. Valid visible and valid invisible. Right here, we have a high. Okay, see how it's a high because it goes higher than this with closure, and then we go close below it. We have a high, we have a low, protected low, we have a high, right? We go close below the protected low right here. High, low. Sorry, let me just restart this. Let's just get rid of all this. I'm just going to show you. I don't need to explain candlestick structure, honestly, at this point. High, low, high, low, high, low, fake flip zone. Boom. Done. Right? Nice fake flip zone up there. Okay? So because we have this fake flip zone here, that makes this a 15-minute swing, not just because it's a fake flip zone, but because technically speaking, visibly, this is absolutely a valid 15-minute swing. Whether we like it or not, this is a valid 15-minute swing right here. Okay. And then here is the low tap back, which we get a little bounce from, as you can see. We don't hit the 50, but we get a low tap back. There's a flip up in here. You can take that, take your trade, go take your 15-minute high or whatever it is. This is a non-structural high, beautiful draw. It looks like it touches to the tick. You probably would hopefully be even more conservative, especially if you're getting in, on a flip or something and having a stop loss tight enough. You really don't need that maybe at 2R, whatever. You should be satisfied, in my opinion. But yeah, let's talk about the flip down. So this is the Mark II. Here's the flip down. Bearish example, because I know you guys like bearish examples to help you learn. First of all, here's our flip down. Here's a beautiful touch into the 50%. Now, once we touch that 50%, boom, it sends us down. Where does this send us down to? It sends us down below the lowest point that we went when we went out of the zone. So remember the Mark II. What is the Mark II? The Mark II is the level where you have gone down, right, and close the flip. You put in a low, and it doesn't have to be structural. It just is the lowest point before traveling back up into the zone. Once you travel back up into the zone, you would identify the highest point that you went into the zone before sending and going below the lowest point that you put in outside of the zone, right? So this is the Mark II here. Now, look what happens. When we sweep it, we sell off really, really big, okay? Really big. And obviously, this is not to be expected, but the target of the invisible zone in this instance would not be that. It would be it would be more like the bottom of the bottom of this, right? Especially because we've got an external low here. This is a target. This is a place for price to go move through. Okay, so we're taking out something that is typically strong and reactionary, and we're looking for something that typically has a pull for liquidity for the market to travel through. Right. This is as simple as that. Now let's go and identify the entry model here. Okay. Typically, I'm going to be looking on a 15-minute Mark II base level. I'm going to be looking for a structural flip on the 1 minute, but if I have to use other means to identify an entry, I will. Let's talk about this one right here. Take a look. So we have a low, a high, a low, a high, a low, a high, a flip down, high, low, high, low, high, low, flip up, flip back down, flip back up. So it's just a mess, right? And then high, low, high, flip down, high, swing down, fake flip zone, gets pushed through. Where's it headed? Right? Where is it headed? First of all, this would have been a beautiful entry model for this is another way to trade the Mark II as a point of liquidity, right? That you're targeting. You would see it come up to the 60. You would see it clearly make its 5-second flip, probably, right? 5-second flip right here. I'm not going to be able to go back this far to see it, I don't think. But I'm going to assume this is a 5-second flip here, okay, to the downside. And then we flip back up over it, and boom, we know that the 1 minute is going to flip up now. So we know that we're going to take this out, and if we take this out, then we're taking out a fake flip zone 1 minute, which makes it a double fake flip zone. If it's a double fake flip zone, where's it going? Probably to a 15-minute draw. So it's going to a 15-minute draw. So you can get in on a long here. In this instance, you can get in on the long once it comes back above that, and you can target that 15 minute. That's probably not a good RR, but there would be opportunities to move your stop loss higher once you're actually making swings up out of here. And yeah, I mean, there are arguments for finding places for more conservative stop losses, but that's not the point of this right now. I want to focus on the short. So 1 minute, we're on the 1 minute. Obviously, we have a high, a low, a high, a low, a high, and then boom, a lower low right here. So we have a flip down. This is our flip down as soon as we take that 15. Notice how the 15-minute mark two, notice how we don't hesitate very much. And then we get this beautiful reaction off of this fractal little SNDR right here, right? Okay. And then there's a massive sell off that follows that. Massive sell off that follows that. So the Mark II, beautiful precision on this example. And then I actually have one more bearish low tap back example that I want to talk about, or high tap back, bearish high tap back example. But yeah, this is the Mark II. I mean, we have a flip down, price comes up in, it touches, it pushes the low, it takes the low that it came from. So we believe that if we go back above that high, that we will then again take the low that we came from the second time. Boom. Make our flip. Once we make our flip, take our trade. Once we take our trade, take profits at conservative levels, right? And then take your main profit at your main target, and then let your runner go. Maybe you would get lucky. Maybe you would get a 950-point trade like Ruski. I don't know. I hope that you do. Um, Now let's talk about this last example, and we will really be done. So once again, after this, we have a swing, right? From here to here. You guys know that this is a structural swing because you know structure. Now look, it doesn't come up and it doesn't take this out, but what it does do is it takes out some of these wicks here. It doesn't take out the highest wick, unfortunately, which would have been really nice. That's what we really would have wanted to see, okay? But notice how it's got all these wicks here. These are more this is not a high tap back, this is my bad. These are more of non-structural high kinds of things. You can look on the 1 minute and you can find price trying to make little pullbacks and failing miserably. Um, where is the, hang on. This is so hard to like. I wish that they made this UI better. Let me just highlight this whole area real quick. I want to point out just, people are always stuck on trying to identify like where price is going to be passing through and stuff. But look how we've got all these, swings here. See this? So we got a swing on the 1 minute here. We've got another swing on the 1 minute here. We've got another swing on the 1 minute here. And these are structural on the 1 minute, but to the 15, they're just wicks, right? They're just wicks to go get taken out. People might be thinking that they're stop losses, right? But that's just because they're only looking at the lower time frame. You can identify these as non-structural lows or non-structural highs on the 15 minute and use them as liquidity and then find entry models from the lower time frame. But it's going to be a better example in the 2 hour or on the 1 hour potentially. I know that there was an example. I've just got to find it. It's a good example. Hmm. I can't find it. I mean, I know that, I definitely identified this as a draw early on, right? But obviously it goes, pretty significantly through it before making a 15-minute flip. This is more along the lines of the example that I told you guys in the market structure trade model video, the basic market structure trade model video, where I said you're either going to go at up to the 50% of this, or you're not going to go into it at all. and anything between entering into this and the 50% is sort of like no man's land. This is more of an example of that, I would say. So there's that. That's pretty much wraps it up. Like you wanna identify what you're looking for. So let's do some diagrams real quick. You want to identify what you're looking for. If you have a bias for longs, right? And let's say that the 2 hour is, let's say that the 2 hour is bullish. This is the 2 hour and it's just swinging up, right? And you have then on the 15 minute, you have price has flipped down and then it makes it flip up and you're thinking, okay, this 2 hour is bullish. The 15 minute has made a Mark II right here. It swept this out. It comes back in, takes that Mark II, and then zoom into the 1 minute right here. And you see that it makes a swing down. And then you zoom into the 5 second, and you see that it makes a flip down above the 60%. And then it takes that flip. Then that's the idea of this whole thing. It's the same. It's going to be the same way. I treat it the same for the Mark II, for the low tapbacks, for the non-structural highs and lows. This is just how I trade. I'm looking for the market to, I'm looking as small as I can, right? People are like, oh, these are sniper entries. It's like, well, it's just I'm using confirmations from the lower time frame to take trades that are going to play out on the higher time frame, right? Um, I'm looking at this 1 minute swing right here, and then there's a 60% tap, and then the 5 second flips down, and then the 5 second flips up, and then what do I believe now? I believe the 1 minute's going to flip up. Now, what if the 1 minute flips up? Well, if the 1 minute flips up, then that's a good quality setup because it's a 15-minute Mark II. Okay, well, what if the 15-minute Mark II reacts? What's it probably going to do? It's probably going to go take the high that we came from. What happens if we take the high that it came from? We just made a fake flip zone on the 15, or we just at least we swung up at the very. If this was just a wick, just a sweep above this, right? If we took this with closure, then this is a flip down and it would be a flip back up. What's going to happen? It's probably going to take the 2 hour high. So you guys start to understand, like, from a 5 second confirmation of a fake flip zone, right? I'm talking, look, let's, you guys have to, let's start over from scratch real quick. We're going to start with the 2 hour is blue, okay? The 2 hour is blue and we're swinging up, okay? 2 hour is blue and we're swinging up. Now we're going to go to the 15 minute and this is going to be red, okay? 15 minutes is going to be red. I'll just draw it real quick so that you guys can see. Change it to red. All right. Now this is the 2 hour. This is the 15 minute. This is going to be the 1 minute now, okay? We swept out the Mark II right here, right? Swept out the 15-minute Mark II. Let me mark it out. 15-minute Mark II. Gonna go ahead and mark out the 2 hour swing. Okay. Now let's zoom in a little bit. Zoom in. And we're gonna go to the 1 minute. And we'll make the 1 minute black. We have a swing down, okay? A valid swing down, just like that on the 1 minute. External low, protected high. This is black. And then what's the last color that I can use? I guess green. We'll go with green. Now let's go to the 5 second. Let's zoom in. This is a 1 minute swing. Bear swing, okay? Now, for us to take this 15-minute Mark II, I would be looking for a 1 minute flip up. To identify a 1 minute flip up before it occurs, I need to use my fake flip zone entry model on the 5 second. So let's, like I said, we're going to do the 5 second for green because green is the money, right? So we're going here, here, here. Now we flipped up on the 5-second. We're trailing up into the zone. We hit the 60% and we flip down, okay? And then we take that high right there. Now we have a fake flip zone on the 5-second. Fake flip zone on the 5-second. Boom, right there. We know that now this 1 minute is going to flip into, this 1 minute bear swing is going to turn into a 5-second flip up, or a 1 minute flip up. Right, this is, I hope that's actually green. So we have the 2-hour bull swing. Okay, see how I'm aligning these confluences. This happens all the time. This many confluences plays out so many times because we have 3 POIs. We have the Mk.II. We have four POIs. We have the Mk.II. We have the low tapbacks and high tapbacks. We have the non-structural lows and highs. And we have the discount premium line, the 50% of the swings, right? So there are no excuses for not just taking good quality setups because they're everywhere. Everywhere. And if you know how to use the 5-second, dude, you can find it all day long. Just oh look, there's a low tap back on the 15 right there. We just swept it out. What's going on the 1 minute? There's a swing right here. I wonder if it's gonna flip up. Well, zoom in on the 5-second, it'll tell you if it's gonna flip up or not. Okay? So 2-hour bull swing, 15-minute flip down, 15-minute flip up, right? Mk.II, we tap into the flip up. We go take the high that we came from right here. Boom, we now have a valid Mk.II. Mk.II is created. We sweep it out. We make the bear swing on the 1 minute. We take the 60% of it. We flip down. We flip back up. Take your freaking long. Take your long. Put your stop under there for 99.5 points and target your 15-minute. Now, if that's not enough for you, what happens if you take this 15-minute? You should definitely take the majority of your profit, but if it closes, what do we have here? We have a 15-minute fake flip zone. What's a 15-minute fake flip zone equate to an invisible market structure? A 2-hour swing. We have a 2-hour bullish swing with a 2-hour external high, which is a draw on liquidity above us. Why not hold it to here? Why not hold it until the 2-hour closes, right? That is how you guys are going to get these big trades with these big winners and big runners and oh I got 250 point long, 235 point short, whatever it is, right? All the stuff I'm posting that you guys see that I tell you on my trade alerts and I put in the higher time for analysis, it's not fucking rocket science. Like, it's really not. This is the entry model right here. This is the entry model for everything. It doesn't have to use every single one of these time frames. It can be the 15, the 1 and the 5-second. It can be the 1 minute and the 5-second in some instances, right? If you're just on a trend day and you've got you got the non-structural low and you remain bullish on the 1 minute. The 1 minute stays bullish due to candlestick structure. It doesn't actually make a swing, so it doesn't flip down. It puts in a non-structural low. You sweep it out. You flip up on the 5-second. Boom, scalp it. 20 points, done. Like, there are just so many opportunities to do this, but you've got to go back and watch the fake flip zone model again. You have to understand the fake flip zone model. It's imperative, and you have to understand the basic market structure flip zone model as well, right? And you have to understand what a Mk.II is and is not. If you think that something's a Mk.II and you're wrong, you're fucked. Like, literally, you're going to be so screwed. You have to know market structure. If you don't know perfect market structure, like if you watch perfect market structure, those videos, and you didn't fully understand them, and you watched it like once or twice, and you didn't fully understand it, and you haven't gotten it perfect yet, like, you can't be watching this video. You can't be trading using this shit. You're gonna lose your money. You're not gonna know what you're doing, right? So learn market structure, and I promise all of this will follow. All of this will follow if you learn market structure and then you just use the 60% fake flip zone rule. You use high tap back, low tap back. You use non-structural highs and lows as liquidity points. You use Mk.IIs for draws or reaction points with entry models from the lower time frame if you're trying to catch the reversals. All of those things, like, add them up, you have all the entry model is going to be almost the same in every sense. Like, you guys have probably gotten sick of hearing me say the same shit because it's like you don't even have to ask, how did you get into the trade? What do you think, man? It took out a non-structural low or a low tap back or a Mark II or something, and then it showed me that it was going to go the other way. It showed me on the lower time frame that it was going to go the other way. And so I got in and I let it go the other way. I let it play out on the higher time frame. That's how it works. That's it. So there it is. There's the entry model for the Mark II, the non-structural highs and lows, and the low tap backs, high tap backs. Um, yeah, if you guys have questions, please like spam me questions in the premium chat. That know this is a ton to digest. I'm making it sound simple, and you're probably like, you're being an asshole. It's not that easy. Like I know, I understand it's difficult, and it's really difficult to trust. But this is real. Like it's true, man. I mean, look at the example today of the. Let's go to today real quick. We got a short today, right? A beautiful short today. And what happened here? So we have a push outside of here, right? We get down below it, we come back up, we come back in up into this zone here. We make a nice flip down on the 1 minute, okay? And then we make another swing right here on the 1 minute. And when we make this flip up, price shows us that it's going to be going through this 1 minute flip. And then because it's going through that 1 minute flip, what do we have? A non-structural low. This is a draw, right? This is a draw. I already said that to 343 last night in my top 10 analysis video. I already said 343 was a draw. I was looking for price to come up and then go or come up, above the non-structural highs and then make its flip down and go and take out 343. And then if it led to that, I think it's probably going to take out 253. And if it leads to that, then you've got the 2 hour. Is the 2 hour a structural low? No, it's not. Currently, it's nothing but an external low, so it's not a protected low. So it's more likely to be a draw than it is to be a place where we're gonna, we're gonna hold. Now we could hold it, we could not, react from it. We might, or we could react from it, right? We could touch this, and that could be the place where we turn around and go. But I'm just saying, like this right here, this is inconsequential. The market is going to gobble this up. Why? Because there's people who don't know market structure. Why? Because they're not in here, right? And they don't know. Like, look on the 15. What is this? What is this on the 15? 5, 4, 3, 2, 1. If you didn't say external low, what is wrong with you? This is an external low, right? We've got to go get this. Now you may be thinking, well, what about this little flip up here? Go ahead and look on the 1 minute and you tell me. All right, go ahead and look on the 1 minute, you tell me. So this is what I'm talking about right here. We have a on the 1 minute right here. This is a fractal example. We've got a flip up, okay? We go below the 60%, mark it out. Right there. The 5 second does a big flip up. The 5 second comes down, goes up again, comes down and pushes through here with closure. Now this is why we don't put our stop losses if we chase this entry instead of waiting for a retrace, right? Either way, let's say you wait for a little retrace and you get in right here or something, we're not putting our stop loss here. We're putting our stop loss above where we believe the high of the new fake flip zone is going to be. That's a big stop loss, right? So what are we going to do? We're going to wait for other confirmations to get in, or we're going to go with extremely low risk. If you're a swing trader, you can go with like one lot on this or a couple lots on a big account or something, right? And we're looking for price to come through here, but if price comes through here, then we're probably also going to see it come through here as well. Why? Because this is a draw. Why? Because this is an external low. And then look on the 15, right? Where are we headed? To the top of, or sorry, the 2 hour. We're headed to the top of the low. Top of the low is always a great place for targets, okay? And then what can happen on the 1 minute here? When we're narrowing down, when we trade, right? We put in our swing, we flip up, we flip back down. Instantly, I'm moving my stop loss to here. Why? Because this is just as good as a swing on the 15 minute. So I'm going to put my stop loss there, okay? Then we put in another swing here and another swing here, right? So you can trail 1 or 2 swings behind, but this is a great way to mitigate risk. You wait for it to come up and wait for it to show that it's going to do it again, right? Look, we have another example right here. Look, a flip up. Woohoo. Flip up. Hit the 60. What happens on the 5 second? Flip up. What happens? Flip back down. Fake flip zone below the 60. What's going to happen? This thing is going to get flipped back down. That's going to equate to a 15-minute swing. I'm going to put my stop here and I'm going to trade this as if it was a 15-minute swing. If it was a 15-minute swing, where would it be going? I don't know. Probably the 15-minute external low. It's probably going to close out of there. I can probably exit this trade right when it closes. Boom. Okay? Study the hell out of this. Ask a bunch of questions. Be mad at me for being nonchalant about it and being an asshole about it and being too confrontational, whatever. I don't, whatever you need to do to learn this, do it. All right? And talk to me about it. Talk to me about your progress. Keep me updated on what's going on. And I will see you guys in the next one. Yeah, stay safe. Peace out.